The views and opinions expressed on Unlock Your Wealth Radio are those of the host, guests, and callers only and are not necessarily the views of Unlock Your Wealth Radio, Heather Wagenhals, or Success Publishing International.
More willpower than a barefoot woman at a shoe sale. Able to stretch a single paycheck for an entire month. Makes money concepts easier than third grade math. Introducing your purveyor of prosperity, Heather Wagenhals.
Work all day, stress all night. Take your mind off your money and focus on your life. Money don't matter or the stuff it bought. It's the way you think, not what you've got, yeah.
Unlock Your Wealth Radio starts now. Get your money mind right.
Get your money mind right.
Get your money mind right. But first, this segment of Unlock Your Wealth Radio is sponsored by Audible.com. Get a free audiobook download at unlockyourwealthradio.com/free book and click on the link to over 150,000 titles to choose from for your iPhone, Android, Kindle, or MP3 player. Welcome to the show, everyone. Yay! Remember Fantasy Island? Welcome to Fantasy Island.
Oh, I remember.
Welcome to Unlock Your Wealth Radio. I am Ricardo Montalban.
I had a song on that show.
Did you really?
I did. Fantasy Island.
You know, Fred had a mini car. You know, Tattoo's car? That's...
I mean, I wasn't a big fan of the show, but Mickey Gilley was on the show once.
Well, yeah, well, Fred knows him. So did you... So, you know, Tattoo was one of his best friends. So that little mini car is Fred's mini car.
Really?
Yeah. Fred designed mini cars. That's how he... Because he was at an Aaron Spelling party, and that's how he met Farrah, and that's how he...
and Fred knows Mickey?
Mm-hmm.
Wow.
Yes, sir. Because his best friend was some cowboy guy. Oh, my God, his name escapes me. I can't think of it.
Well, tell Fred I wrote Texas Heartache.
Oh, he'll be so excited to know that.
It was on the Put Your Dreams Away album.
Oh, my gosh. He wouldn't that be funny if he had it on like his little iTunes mix? I'll have to take a look at that. Anyway, everybody, you're probably like, what the heck? Who are these people?
It's the music trivia part of the show.
There you go. As you slowly usurp my keys to riches. Anyway, folks, I'm Heather Wagenhals, your purveyor of prosperity, and this is the maestro of moolah as well as music, Michael Terry.
Thank you very much.
And we will help you get your money mind right on today's show with the following 8 features. So first off, we have this week's key, which is...
Forget the perfection principle.
I know. Key 11.
FPP.
FT.
FTPP.
FTPP. So anyway, so forget the perfection principle. We have a great moolah word of the day. If you've ever done a check over the phone or created an automatic debit from your checking account, we're going to talk about how that happens with our investor word of the day. And in the interest of this week's, well, actually this month's celebration of awareness, it is the National Life Insurance Awareness Month. That is going to be our topic for today's show as we talk about the myths of life insurance, because
good topic.
It is. I have decided opinions about it, and I've had people on the show here. We've had a couple people, and I almost feel like I did myself a disservice by kind of playing along and listening to them tout the benefits of their product when I know that type of life insurance, the universal life, I love you life, whole life, all of that life stuff, with the exception of term, is a problem.
Yeah.
Because investments and insurance shouldn't mix. And I'll explain why when we get there.
Cool.
So we're going to talk about life insurance because it is a critical piece for building wealth, but it's not a lifetime piece, because if you think about it, life insurance is not about your life anyway. It's about the lives that continue on after you have left the building, like Elvis. So we're going to talk about that on today's show. So it should be pretty exciting. We'll have a lively discussion. So anyway, moolah word of the day.
Bring it on.
Shall we? So this week's moolah word of the day is actually an acronym, and it is ACH, Alpha Charlie Hotel. That's the aviators phonetic alphabet, but the actual acronym. I'm just showing you my prowess in other acronyms. Because you know what's really funny is the police use they're like, all names. All of theirs are names. But in aviation, it has nothing necessarily. There's a couple of them, Romeo.
Yeah.
But, not all of them have names. So ACH stands for Automatic Clearinghouse. It is a nationwide electronic funds transfer network which enables participating financial institutions to distribute electronic credit and debit entries to bank accounts and to settle such entries. So if you have ever done a check over the phone and they ask for your routing number and then your account number, or if you've ever set up auto pay and they ask you for a canceled check, all of that processes through this automatic clearinghouse, the ACH. Okay. And so they manage all of the transactions and send the money and they take it out of this account and put it in that account. It's different than charge accounts.
So there's one company that does this.
Yeah. One place.
Wow.
I know.
Talk about a monopoly, huh?
Kind of.
Yeah.
Pretty crazy, isn't it? I thought so.
Maybe we should get into the business and offer some competition.
Well, I mean, that's why, I knew, I remember when I don't know, I've always been enamored with building wealth. And I just knew that I remember telling my father that I was angry at him because I was born into the wrong tax bracket. And I was like, I was meant to be rich. What is this? And so, I had looked at becoming a bank, and I remember when I was 18, I looked up the rules for becoming a bank, and you only needed to have $50,000 to start a bank. And I'm like, I'm so starting a bank. And then I so fell for a guy and then had to buy a house.
50 grand, that's all you need. Huh?
That's all you needed back then. I'm dating myself. That was back in the 80s. But yeah, you only needed 50 grand to start a bank. Now, I don't know how much it is. But I am a lender, so it's not quite a bank because I don't accept deposited funds, but I do lend money. And so I'm still reaping the benefits of being a bank of sorts, if you will. So yes, the Automatic Clearinghouse is a nationwide electronic funds transfer network. So it's a participatory thing. So not every bank joins it, but it's how you can use your checking or savings account to draft money without a physical paper check or the use of a debit card. So I think we need to make sure that we understand what that is. So that's this week's moolah word of the day, or moolah acronym of the day, if you will. This week's key is our 11th key in the Keys to Riches financial philosophy, and it is...
forget the perfection principle.
Yes. So this week's key is an awesome key because if you think about it, we've really come so far in what we've done with our keys. I mean, just think about, we're almost at the 90-day mark. We have made some unbelievable strides, and we've materially changed the way we look at money, the way we handle money. We've evaluated our past behaviors. We've made structural changes in our behaviors so we can program new ones to override the ones that aren't supporting us. And we're getting ready for next week's key, which is...
remember real estate.
No, that was last week's.
Practicing the 3 R's.
There you go. So we're getting ready for our review, revise, and recommit. And this is the reason why this key is in front of that. Good job there, big guy. The reason why this key is in front of that is because we need to learn how to manage catastrophe. And so the first person, and usually the hardest person to forgive, is ourselves. And so this week's key focuses on how we can take the meaning of our mistakes forward and ditch all of the baggage, all of the emotion, all of the guilt, the self-worth issues. And so that's what we're going to learn on today's key. But we're not going to learn it here. We are going to learn it on our other show because the Keys to Riches has gotten so big and so popular that it's its own syndicated show.
Right.
And it's available on Libsyn and on our channel, or also on iTunes. But it is also its own website too, keys-to-riches.com, which is totally dedicated to the financial philosophy. And so if you are interested in learning more and delving into this week's key, as well as signing up for our video course that is free, one of my favorite 4-letter F words. And this, so you can learn all of them. It's a video course instructed by yours truly. And so that's at keys-to-riches.com. If you want to learn more about this week's key, you have to listen to that in its own show. But it'll be super fabulous, I promise.
Okay.
Which now frees up our time to talk about insurance.
Life insurance.
Specifically life insurance. So for those of you who have not been with us the whole season, our fourth key in the Keys to Riches is knowledge is power, not knowing is powerful. And this is where we learn all about what it is that we're supposed to know about money. And then we evaluate, we do a knowledge checklist, and we identify what it is we do know and then what we need to learn. And in this key is where I have developed my 3-5 financial strategy and my 5 minutes to financial wellness program. Because ideally, if you just spend 5 minutes a day managing your money, you can be financially free. It's that simple.
Really, that's it. 5 minutes a day.
So 3 questions, 5 areas of concern. The 3 questions we answer along the way in our keys, which are...
Oh, boy. I know it starts with a W. Where am I?
Where am I?
Where am I going?
Where am I going?
What's the difference?
Ding, 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 ding!
That's good. Who am I?
Hello. Yes, our 3 W's. Where am I? Where am I going? And what's the difference? So where am I is our what?
Well, your
balance sheet.
Your balance sheet, not where you are physically in the world, but your balance sheet.
Yes, that's what GPS is for.
Right.
This is our financial GPS where we figure out where we are, and we use that. We use a balance sheet to determine how much we have, how much we owe, and what the difference is, and that's our net worth.
iBank or Quicken would do the same thing. That's a balance sheet, right?
It can create one.
Yeah.
It's a ledger if you wanted to be technical.
Right.
It's a ledger. And you can create a balance sheet from what's inside.
It's my favorite software.
There you go. Yes. Yeah. Quicken is kind of the deal. They sure spanked, Microsoft Money out of the water. Is Microsoft Money even around?
I don't know.
I used that because it came free back in the day when I bought my Windows 95 computer.
Quicken, I think, started as a Mac program, and then it just moved over to Windows, and then it started taking care of Mac people, and now it stopped making it altogether for Apple.
It's cloud-based. Siri is having a problem with that.
Uh-oh. So now the Apple people have iBank.
Yeah.
Which is good. It's a good program.
So, because you people are kooky.
Yeah.
You iKids. But that's another show, my opinion on iKids. So we got our 3 questions. So we've got our balance sheet. Where am I going? Those are our goals. And what's the difference? That's our cash flow, our savings and spending tracker for our monthly or our daily expenditures and incomes and outgoes. Right. So then we move to our 5 areas of concern. And that's what this week's show is all about, is one of the 5 areas of concern. So do you remember the 5 areas of concern?
Oh, boy. No, I don't. I'll be honest.
There you go. I appreciate the honesty. So first we have income and expenses. Then we have what?
Starts
with a P.
Preservation of...
No, that's further down.
Yeah.
The second one starts with a P, and that's where we're at. P-ro...
Oh, protecting our
protections. So we have income and expenses, protections, asset accumulation, asset multiplication, and asset preservation. You were jumping to the final one.
Yeah, which is typical.
So asset preservation is about legacy planning and stuff. But This one actually falls under protections. And because it's National Life Insurance Awareness Month, I want to make sure that you're aware of what its limitations are. And there's a great article on Bankrate that if you just Google Bankrate article, Myths of Life Insurance, that's what we're going to talk about today. This is kind of the foundation for our discussion. I sold life insurance at one point in my financial advising career. And so I have decided opinions about it. So as we talk about this area of concern, protections, insurance is not about getting rich. Insurance is about ensuring our success financially. And so we buy car insurance because if we hit somebody or a pole, we can utilize the insurance to pay for damages, for medical bills, etc., for repairs and everything.
We're required by law to have.
Well, yeah, but that's notwithstanding. So, but we use that so we don't have to dip into our pockets or to necessarily have those deep pockets. So insurance, like a lot of people think, insurance is a waste of money, but insurance is renting millionaire status before you get there.
Right.
And that's when we make a fundamental shift in how we look at insurance, we can be more strategic about it. So if insurance is about renting millionaire status, this is my very first argument when it comes to life insurance. If it's about renting coverage, why would we invest in it? Mm-hmm. It is not an investment. Everybody, and like I said, I've had guests on this show that tout the miracles of life insurance as an investment, but it is not an investment. And here's here's a quick litmus test on how you can determine whether or not it is an investment or it is an insurance product. But first, this segment of Unlock Your Wealth Radio is sponsored by KeepMyID.org, the only service that actually prevents identity theft. All others are just monitoring services. Put your credit on lockdown with their special offer for Unlock Your Wealth Radio listeners. Visit unlockyourwealth.com/KeepMyID and click on the link to start protecting your financial future right now. Remember to use promo code WAGS. So here's like a litmus test, and you can get this from a book by Howard Dacey. He wrote a book in the 70s called What's Wrong with Your Life Insurance? And that's, when a lot of these policies, these whole life policies, and now they're universal life, they got all these types of blah, blah, blah life.
I was a sucker. I got into it.
Yeah. So they have all of these things that call themselves life insurance. And there's a bunch of different moving parts. But when you take money that you've earned and you put it in the bank or you put it in your investment or brokerage account, depending on the type of investment that you put it in, it's liquid. You can get it out. You might pay a penalty if it's in a retirement account, but you can get it back out, like right then and there. And 100% minus any fees, like for selling shares or whatever. Mm-hmm. But ideally, you get like a bulk of it back, the majority of it back. Is just a little bit is skimmed off for fees, for resources. But if you put that same amount, let's say you get talked into a whole life or a universal life product, and you put like 10 grand into it. And the next day, all of a sudden, you have somebody from some foreign country that's going to give you a whole bunch of money, and you need to wire them $10,000 right now so you can help them move $240 million into your name because they want to escape the oppressive government that they're in.
Right.
And I say that tongue in cheek, but we always have legitimate emergencies. And so you need that money back. So if you call up the insurance guy, are you going to get your 10 grand back?
No.
Exactly. So if you don't get it all back, you're not even going to get part of it back because it hasn't, quote, accumulated cash value.
Right.
So all you have is overpriced insurance for 10 grand. You do not have, it's not an investment.
Do people buy it that way? Because I
Yes.
told you my story. I put in $25 a month for
Right.
years and years and years.
Yes, but rich people and upper middle class people get hoodwinked into this all the time.
No kidding.
Yes, because they're told rich people use it to hide money and blah, blah, blah.
Oh, okay.
You know, and you can put money into it and take it out tax-free because you borrow against it, but then you don't have to pay yourself back. But if you do, you keep the interest. I mean, it's way too convoluted.
Yeah.
You know, it makes me think of that update about that we did about happiness and about materialism. You know, and more stuff only equals more stuff.
Yeah.
And we need to have a simplified way of doing things. You know, when it comes to clearing the clutter and containing all of our projects. And the more sophisticated any process becomes, the less successful it will likely be. It's always the simple things. You know, the simple little widget that sells 100 million units.
Right.
Right?
Right.
You know, but like how many people buy like super sophisticated event planning software?
Yeah.
You know, that manages the details down to what room somebody's staying in, what meal preferences. Like how many people buy that?
Yeah.
But everybody will buy like a little flashlight that hangs on their key ring.
Right.
Because it's simple.
Yeah.
We understand it. We get it. We know how to use it. It's a simple like purpose. And the people that make those little flashlights will sell 100 million units.
Yeah.
Like that. You know, so simplicity is key. And so when you get too many moving parts in any investment, I mean, just think about, you know, the savings and loan scandal. You know, there were so many moving parts about that with Charles Keating and all of that. So simplicity is the key. But let's talk about some of these myths here from this. Jay McDonald wrote this article for Bankrate. And it's right on the money. So the first myth that he talks about is that life insurance is not really life insurance. It's really death insurance because you never live to collect it. So let's talk about, as we move through these, let's pepper this with some truth. So what is the purpose of life insurance? Well, if you have an insurable interest, and we'll talk about that in a moment, then you need to have life insurance if you're not already independently wealthy. And if you are uber independently wealthy and you actually would like to see your kids enjoy what it is that you're passing down, and I can think of Joe Robbie Stadium as one example where the kids couldn't afford to pay the taxes, so they had to sell the stadium. They couldn't keep the stadium. So if you were uber wealthy, then you can use life insurance as a tool to offset the death taxes, the inheritance taxes. So that is what life insurance should be used for. Okay, it's a tax-free benefit to whomever receives it, but it's and it's usually used to offset other stuff. Now, an insurable interest means that you have debts that you owe, or you own property that will have to be distributed amongst heirs. And heirs are not necessarily a reason to have life insurance, but if you're financially responsible for people, that is when you want to have life insurance. Okay, so if you have kids, if you have a spouse that's not working, that's taking care of the kids, if you have a business that two people are involved in or more, you've got partners, let's say, one is the intellectual property side, one is the sales side. And if one of you goes, how do you replace that person? Plus, if there are spouses, do you really want the spouse coming into the business, or would you rather be able to buy them out? So that's, key man insurance is a business form of life insurance. So all of this makes sense. It's important to be able to have insurances in place. Now, there's the older you get, the more expensive it becomes. But life insurance as a whole is going down. And it's because of what this little term in the industry is called the compression of morbidity, which means we are living longer lives and at a higher quality. And so the cost of life insurance is actually going down. But as you age, the premiums will go up.
Right.
But you don't necessarily need it when you're older. You need it when you're younger and you're starting out. And again, you have that insurable interest. You know, you are financially responsible for a spouse and children, or maybe a special needs sibling or parents, you know. So if you have this burden, you have to be able to pay for this. And there's a way to figure it out on whether or not you need life insurance and on how much. So the idea is that that money gets invested, you know, once it's paid out. And the way to calculate how much you need is determine how much you owe. And, you know, because if you have a non-working spouse, then you want to make sure that they don't have to worry about how do I come up with a mortgage payment and stuff on top of living expenses and everything else. So you want to make sure that you have enough life insurance that covers your debt, and then 10 times the annual expenditures for those people to survive. So like if you have a brand new newborn, they say it's $250,000 to raise a kid from 0 to 18. So you already know that number. So that's an easy number to get, 250. All right. Let's say you have a newborn and then you have a 5-year-old. So you don't necessarily need 250 for the second kid.
Right.
You know what I mean? So you've lopped off part of that. So maybe you only need 200 for the next kid. Okay. And then, you know, calculate the household expenses, you know, for water, gas, you know, utilities and stuff. What are the living expenses for the property? Then lump in the mortgage amount. And you want to create this big pile. And it seems like, oh my gosh.
For how many years would you do that?
Well, until you can self-fund. So if you get like $1 million worth of coverage, let's just say that it's $1 million is the need. All right. It's dirt cheap when you're young anyway.
Yeah.
And the prices are only going down because, again, quality of life and stuff like that. So after you hit age 25 and that prefrontal cortex is fully developed, so you're not doing crazy stunts like driving recklessly and stuff like that, all insurance goes down. It's so great. So you start a policy at 25 to provide for your family. And, you know, maybe it'll take you 10, 20 years. It depends on, you know, what type of business you're in, how well you save money. And then the idea is that you only need it for a specified period of time, because then you become self-insuring once you get rich yourself.
Right.
Because once you get rich, once you get those bigger dollar amounts in the bank and you use the rule of 72, which tells you how many years it takes your money to double, every time it doubles, it's going to double exponentially. Because then, you know, as soon as you hit that magic number of like 100,000 then becomes 200, which becomes 400, which becomes 800 and 1,600. You know, now you're in the millions. So depending on, you know, how many, and so, but 1.6 million becomes 3.2.
Yeah.
You know, and if you make 12%, your money's doubling every 6 years.
Wow. Yep.
Yes. And that's not, and that's on its own without adding to it.
Right.
That's just exponentially doing its thing. And 12% is realistic in today's marketplace. Banks aren't paying it. But if you're savvy and you find the right investment tools, you can easily make double-digit returns and be able to generate that kind of wealth. And again, you know, so then 3.2 becomes 6.4 and then 12.8. And now it just becomes silly at that point. Yeah. So you need to cover the gap for your family, you know, especially because if you have small children and you're choosing to do the homeschool or stay at home spouse route, then you've got to be able to provide for that. You know, otherwise somebody's going to have to go to work and your hopes and dreams for your family are going to go out the door. Yep. So you got to plan for that. But there, you know, that's some of the things that we didn't even get to this article, and we're already at the end of the show, but that's how you want to strategically plan for life insurance. And if you want a worksheet on how to calculate your insurance need and to determine your insurable interests, just visit our website at keys-to-riches.com and get your financial 5. And it's in there. It's in all of those documents. And so just look for the life insurance worksheet. So thank you so much for stopping by. And for more great resources, including interviews with some of the latest financial gurus, please visit our website at unlockyourwealthradio.com. And for Unlock Your Wealth Radio and the maestro of Moolah, Michael Terry, I'm Heather Wagenhals. Now go out and unlock your wealth today.
UnlockYourWealthRadio.com is produced by Heather Wagenhals and the Unlock Your Wealth Foundation. UnlockYourWealthRadio.com and its affiliates are copyrighted 2016 with all rights reserved. For more information on the Keys to Riches Financial Wellness Series, please visit our website at www.unlockyourwealth.com.